So the last time we looked at how to account for financial assets in the books of the issuer or in the books of the seller. So today we are coming to look at the financial assets, or we are coming to look at the financial instruments in the books of the buyer or in the books of the purchaser or in the books of the acquirer. So if you are the one buying or purchasing or acquiring the financial instruments, that will be an asset to you. And how do you account for that? Okay. For the purchaser can have financial asset through the following means. So they can have a financial asset through equity instrument. You can buy shares from a company instead of you classifying it as what? As investment in associates or as a subsidiary. You can elect to classify it through profit or loss or through other comprehensive income. So financial assets, the first one is that a company can get a financial asset. So the financial assets can be through equity instruments. Equity instruments. So the financial asset can be through equity instruments and can also be through, okay, debt instruments first. Then we have, so let me write the equity instrument first. So it can be through the equity instruments and can be through the debt instruments. Okay. So a company can buy shares or a company can acquire shares in other company. That is going to be an asset for them. And the company can also invest in a debt instrument or acquiring a debentures from another company. That's also going to be an asset to them. So let's come to the classification one by one. If the financial asset is through equity instruments, okay. If it is through equity instruments, how do we classify them? Okay. If the financial asset is through equity instruments, we have two classifications, only two classifications. We have through profit or loss. So we have classification through profit or loss and classification through the other comprehensive income. The other comprehensive income. So the true profit or loss is just like the debt instrument too. Our transaction cost will be expensed. Our discounts, all those things will be expensed. So the assets, the instrument will be carried at fair value. At the end of every year with fair value, the fair value gain or loss will go to profit or loss. So for profit or loss, the transaction cost is expensed. Transaction cost is expensed like how we do for the profit or loss through for the financial liability. Transaction cost will be expensed. They can pay you dividends. Maybe the company will pay you dividend because it's so dividend received. Dividend received recognized in profit or loss. Discounts received in profit or loss should be recognized in profit or loss. Everything, every transaction cost should be on profit or loss. And at the end of the year, you fair value the instrument. So you can buy the shares for 50 million. So the company will pay you a dividend. So if they pay a dividend, the dividend will be taken to profit or loss. Okay, at the end of the year, they are now telling you that the fair value of the instrument is 53 million. It means that the value has increased by 3 million. This 3 million will be taken to profit or loss as a fair value gain. it will be taken to profit or loss as a fair value gain. And your instrument will now brought to 53 million. Okay, so that is how the profit or loss classification works. What about the other comprehensive income? So if it is through other comprehensive income, although we are not going to be, so the question will be telling you that the instrument is being held for speculative purposes. Speculative means that we are holding it to sell it within a shortest period of time. It's for business. We are holding it for business. Or the question can say the company is holding this particular instrument for trading purpose. So they will tell you that they are classifying it through profit or loss, or they will just add a statement over there for you to know that this is going to be classified as what? Through profit or loss. So they will say it is for speculative purposes, or it is for what? Trading what? Purposes. So you have to know that that will be true profit or loss. They can sell it within what? A year. Or even they can purchase it the next day, the price has increased. They can sell it. All right. So let's look at other comprehensive income. So other comprehensive income. Okay. Other comprehensive income. We have the instruments. We are going to have the transaction cost. Transaction cost will be capitalized. The other comprehensive income is the what? Is the not true profit or loss for the financial liability. We are not going to sell, we don't have the intention of selling it. So even if you don't have the intention of selling it, we don't use amortized cost for equity instruments. No, it will be there forever. We don't have the intention of selling it. So it is going to be there for some period of time, or it will be there forever. Okay, it will not be sold within a year. So the transaction cost will be capitalized. Okay, our discounts received will also be capitalized, meaning that we are going to be taking the discount received from our fair value. Okay. The dividend that we receive will go to profit or loss. Either it is dividend received recognized in profit or loss as income. So dividend received will be recognized in profit or loss. Okay. This one too, we do a fair value. So at the end of every year, the fair value gain or loss to other comprehensive income. So for this one, the fair value gain will go to other comprehensive income. Okay, but for profit or loss, the fair value gain will go to profit or loss. But for this one, at the end of the year, we also fair value the instrument to see whether the value is increasing. The value is increasing, that will go to other comprehensive income. Or if it is reducing, that will go to other comprehensive income. So the classification of equity or financial asset through equity instruments is only two: profit or loss or other comprehensive income. Profit or loss is for speculative purposes, but for the other comprehensive income, we don't have any intention of what? Disposing of that particular investment. All right, let's go to financial asset through the debt instrument. Financial asset through debt instrument. So let's come to the debt instrument. The debt instrument, what will happen is that we add additional classification to this. Okay. So the debt instrument can be debentures, can be bonds. So this, the first one, will be through profit or loss. So this profit or loss, the profit or loss will still work like the equity instrument. Transaction cost expense. Transaction cost expense. Discount received expense. at the end of the year, you, so at the end of the year, so transaction cost expense, they will give you interest income. Okay, interest income, interest income received, interest income received should be recognized in profit or loss. Okay, interest income to profit or loss, transaction cost expense, discount received expense, then the interest income will always be the coupon interest. Okay, that will be the coupon interest. So they'll give you the coupon interest on the what? On the normal value, the coupon interest on the fair value or on the purchased amount. Then that will give you the interest income. At the end of the year, you fair value. The fair value gain or loss will be taken to the fair value gain or loss should be taken to profit or loss. Fair value gain or loss to profit or loss. So for the debt instrument, the question for the equity instruments, okay, for the liability instrument or for the financial liability, what we do is that we use the duration to determine how the instrument will be classified. But for the equity instruments, sometimes using the duration will deceive you. So what you will do is that they will be adding what? They will say that the business model for this particular, or the company decide to use a business model of what? Holding the instruments up to maturity, or holding the instruments waiting for an important opportunity to sell it or something like that. They will be using certain English or grammar for you. Okay, so for the profit or loss, they will say that it is a speculative what instrument. It is for trading purposes. As soon as the question see that the organization is holding the instrument for speculative purposes or for trading purposes, it means that the instrument, or they are going to be classifying the financial asset through profit or loss. Okay, so we have the profit or loss. That is it for that. We also have what we call the other comprehensive income. So the debt instrument can also be classified through other comprehensive income. Okay, so through the other comprehensive income, transaction costs should be capitalized because this will be for a period of time. Transaction costs should be capitalized. Our discount received should be capitalized. Even if you have premium, the premium should be capitalized. Then we have interest income. The interest income to profit or loss. Then we have the fair value gain. So at the end of the year, we fair value gain to be other comprehensive income. So what are they going to be saying before you know that the instrument is through other comprehensive income? The question will say that the entity is willing to hold the instrument up to maturity, but they'll also be waiting for a better opportunity to sell the instrument. So they will say that they are willing to hold the instrument up to maturity. However, they'll also sell the instrument if there is a better opportunity, or they'll be waiting for a better opportunity to sell it. So if there's no better opportunity, they will hold it up to maturity. If there's a better opportunity, they can sell it. So they are not going to be holding the instrument. They are not certain to hold the instrument up to maturity. So they will say the company is willing to hold the instrument up to maturity, but they will also be waiting for a prevailing market or an important or a better market to dispose it. If it is this one, it means that they are indifferent. As soon as they are indifferent about the classification, that is through other comprehensive income, either to maturity or either to sell it before the maturity. That will be the other comprehensive income. So they will not tell you that they are classifying the instrument or the financial asset through other comprehensive income, but they will add something. They are indifferent, either to sell it or to hold it up to maturity. If that happens, that is through other comprehensive income. Okay, what about the entity want to hold the instrument up to maturity? Whether there is a good market or not, we are not going to be selling it. So the question will tell you that the entity is willing to hold the instrument up to maturity and they will collect all the cash flows. If that happens, we classify the debt instrument or the financial asset through amortized cost. So that will be through amortized cost. So the amortized cost, we have our transaction cost capitalized, transaction cost capitalized. Then our discounts received should also be capitalized. Okay, because this will all be for the long term. The transaction cost is for instrument that is going to be last for maybe 5 years or 6 years. You can't expense it. The transaction cost should be what? Should be spread over the life of the instruments. So the discount to be same. The discount should also be recognized over the life of the what? Of the instrument. That's why we are capitalizing them. So you also have the finance income. Okay, finance income, which will always be calculated using the effective interest rates. Okay, the effective interest rates. Then for amortized cost, we don't what? We don't fair value. At the end of the year, we don't fair value. Okay, at the end of the year, we don't fair value. So what we'll do is that the same thing at the end of the year, the discount, the coupon will be taken away from the fair value. So we don't fair value the one carried through amortized cost. They just carried as what? As their historical cost. Then we spread it over the what? Over the useful life. Okay. Let's come to the issue of the fair value. Okay, now if I'm solving a question, I will show that. Okay, I will show that. Let's come to what we call charitable loan. Okay, the entity can also give what? A loan to what? To a charity or to a charitable organization. How do we account for that? So maybe you have a company that you are now giving a loan to what? To a charitable organization. That loan is an asset to you. You are giving loan to them. That loan is what? Is an asset to you. But it is likely that you are going to be giving the loan to what? To a charitable organization at an interest rate that will be different from what? From the normal commercial what? Interest rate. How do we do? We have to. So it is likely that you are going to be giving the loan to the people together with what? With grants. Okay, because they are a charitable organization, you will not be what? Charging them the same interest. So what we do is that we separate the part of the loan given to them and the portion that will be for maybe the grant because of the nature of the operations. So the question will give you the interest rate, which will be a subsidized interest rate of let's say 3%, and it will give you the what? The commercial interest rate or the market interest rate. What you have to do is that you just have to find the fair value of the what? Of the instrument. How do you find the fair value? You find the present value of the loan. The present value of the loan, then that will be all the cash flows. So what will be all the cash flows? The interest that you'll be receiving. So you have the interest and you also have the principal payment. The principal payment. The interest will be received at the normal interest rate. Let's see, 3%, but they can give you the commercial interest rate of 6%. This will be the effective interest rate now that you use to what? Present value the interest that you are going to be receiving for a number of period and the amount that you are paying. Okay, so let's say the total loan given is what? Is 100 million, and the market value or the present value is 98 million. It means that you are given a grant of what? 2 million. That should be recognized to profit or loss immediately. All right. So that's how we go about the charitable loan. So we pick a question on a charitable loan. Then you understand how we go about that. Please, if you have question on financial assets, you first of all have to ask yourself, what instrument is giving us what? The financial assets. Is it equity instrument? If it is equity instrument, the classification is only two. Is either through profit or loss or through other comprehensive income. If it is debt instrument, then you ask yourself, what is the intention of the entity towards this particular instrument or this particular investment? Are they going to be holding it for trading purposes? If that is the case, that will be through profit or loss. Are they going to be holding it up to some time and sell it before the maturity date? If that is the case, that will also be the other comprehensive income. Okay, but if you come to a situation where they are willing to hold up to the investment till maturity, then that will be amortized cost. So the classification is not like financial liability that you look at the duration and say, oh, this is going to be no. The question will be telling you what is their intention or what is their business model for this particular investment. Then you have to look at whatever they are doing there and classify the instrument as such. All right. So let's pick like maybe 4 examples, then we know that we are done with the financial assets. Okay. 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 Let's okay. Question 1, 2. Okay, 1, 2, 3. Then we have 5 and 6. Okay. Let's try that. All right. So someone should take the question 1 first. Question 1, 2, 3, 5, and 6.
On first question one, read it.
All right.
Okay. On 1 October 2020, Kenyasi purchased 5,005% 100 Ghana cedi debentures at their fair value of 98.12 Ghana cedis. Interest is paid annually on 30th September. The debentures are listed on the West African Stock Exchange and are due to mature on 30th September 2024, at which date they will be redeemed at 2% above par value. The effective interest rate applicable to the debenture is 6% per annum. Having received future cash flow projections,
Are you there?
Having received future cash flow.
Kenya State directors. Please say.
Are you there?
Yes, please.
Okay, take it from the having reviewed the future cash flows projections.
Okay, having reviewed future cash flow projections, Kenya State directors have decided that they will hold the debenture until 30th September 2024. No allowance for credit loss is required. Discuss how Kenya State should account for the debentures in its financial statement for the year ended 30th September 2021.
All right, thank you. So this is what? This is a financial asset, isn't it? Because Kenya State is the one buying. So this will be an asset to them. Asset to what? To what instruments?
To amortize cost.
It's through what? What instruments?
Debt instrument.
Debt instrument.
Okay. So for a debt instrument, you have the options to what? To 3 classifications. So let's come to the what? Let's come to the question now. Are they holding this particular investment for speculative reasons?
No.
Are they
No.
holding it because they don't know whether they should sell or they should hold up to maturity?
No.
Okay, but they are saying that they are going to be holding this particular instrument up to what? Up to maturity. So this will be classified through amortized cost. This will be classified through amortized cost. So the directors of Kenya State should classify the instrument as a financial asset through amortized cost. The transaction. Do you have any transaction costs here? Do you have any transaction costs in the question?
No.
No.
But do you have discount there?
Yes.
Yeah, there's a discount because the nominal value of the instrument is supposed to be 100, but you are buying it at what? 98.12. So they are giving you a discount, but we don't, since they have already net the discount against that, we just go ahead with the fair value. Okay. You can also see that they are also going to be, this particular instrument will be redeemed in the future at a premium. So the premium has already been taken into consideration in the effective interest rates. Okay, so let's go to this question and deal with it. Okay. So we have question number 1, which will be Kenya State PLC. So the instrument should be, the instrument should be classified as financial asset to amortize cost. Okay. To amortize cost. Okay. So let's come to the initial recognition. The initial recognition will be the fair value of 98.12 multiplied by what? $98.12 multiplied by what?
5,000.
Okay, multiplied by 5,000. The 98.12 is the price of a unit. Debentures or debt instruments are always issued in a unit, and a unit is 100 what? Ghana cedis or $100. But this one, they are now giving you a discount. So a unit is now 98. So you multiply by the total unit that you are buying, which is 5,000. What are we having?
490,600.
Okay, 490,000.
600.
So 490, 600. So this is the fair value. Do we have any transaction cost there? No. No transaction cost there. And we have taken into consideration the discount already. So you just come to your subsequent measurement. The subsequent measurement will now be through amortized cost. So you have your balance at start. So the subsequent measurement will be at the end of the year. This is at the date of the transaction. The initial recognition is at the date of the transaction. So the subsequent measurement will be at the end of the year. At the end of the year, what will happen is that we have to calculate our finance income. So we have the balance at start. $149,600. Then we now have the finance income. We have the finance income. The finance income will be calculated using the effective interest rate. It will be calculated using the effective interest rate. Why? Because of the premium and because of the discount too. Because of the premium and because of the discount too. So we have to use the rate that will take into consideration those issues. So we have the 6%. So we have 0.06 multiplied by 490,600. What are we having?
29436.
29436, isn't it?
Yes.
Okay. Okay. So what will happen is that at the end of the year, they will pay us our actual interest. So we come to the coupon here. The coupon will always be on the what? On the nominal value. What is the actual interest that they are paying us? Okay, it will be 5% on how much?
500,000.
Okay, so that will be 0.05 multiplied by the 5,000 by the 1,000, the 100 rather. Okay, so what are we going to be having?
2,500.
2,500 or 25,000?
25,000.
Okay,
25,000.
so what will be our closing value now?
$495,036.
495,036. Okay, so this will be the closing balance that will be taken to statement of financial position. Please, the actual interest on this particular debenture is 25,000. But why are we having the actual interest income is 25,000? But why are we having the finance income of what? The 29,436 is as a result of the discounts that we are subtracting, and it's also as a result of what? The premium. This particular instrument will be redeemed at a premium of 2%. So all those things are going to be income. So we add it. So that the discount will be an income to us. The premium that we are going to be having at the end of the maturity date is also an income. So we factor all those things into this. That is why we are having this. So the actual interest, assuming there is no discount, should be 25,000. Assuming there is no premium, should be 25,000. But why are we having 29,000 now? The discount has been added to the actual interest. The premium, which is an income, has also been added. That is why we are having 29,000. So the difference over here will be representing the discount and also the premium at redemption. But the actual interest is 25,000. But we have added all the income together, the discount, the premium, and then the interest income. That is why we are having the 29,000. All right. So you show your profit or loss extracts, or you can tell them how much they should take to profit or loss and how much they should take towards to their statement of financial position. So you can say that 29,436, it should be in English. So the company should charge or 29,436 to profit or loss as a finance income, to profit or loss as a finance income, as a finance income, and 495,036 to statement of financial position as a financial asset. So this will be classified as a financial asset. Please, the duration is more than a year, so this will be a non-current asset. Okay, that will be a non-current asset. That is all about this question. Like nothing more that you have to do. All right. Okay. Question number 2.
Question 2.
Okay.
Doma bought a 10-year bond on 1 August 2016 at a cost of 45 million. The bond carries an interest coupon of 5 million. 5 million Ghana cedis paid annually in arrears, and its effective yield to maturity was 12% at the date of purchase. It's 12% at the date of purchase. Doma is holding the bond as a speculative investment, expecting its value to increase and hopes to sell the bond at the profit in the short to medium term. On 31 July 2017, its reporting date, the fair value of the bond had declined to 43 million. The interest rate payment was received as scheduled. Required. Advise Doma on the treatment of the above in the financial statement for the year ended 31 July 2017 in accordance with IFRS 9 financial instrument.
All right. So, Sinema, I saw your hand up.
Hello, sir.
Yes, please.
We did not amortize the coupon rate, the value.
Which one?
The coupon value, we did not amortize it.
I don't understand.
Misha, when we started, we said classify it as amortized costs.
The amortized is a subsequent measurement. You can see that we have the balance at start. We calculate finance income. Then we take the coupon out of it. That is the amortized one.
Okay.
All right. Thank you.
You're welcome.
So let's come to that instrument. How this is also what a debt instrument, financial asset through debt instrument. So it will be classified as what?
True profit or loss.
It will be
Those
true
three,
profit or loss, isn't it? All right.
Yeah.
Please forget about this yield to maturity. You can only have this if you are going to be keeping the instrument up to the maturity date. So this one, we are not having this. It's for speculative reasons, and we want to sell in the short term. So what will happen is that the instrument will be carried at its cost, which is be the 45 million. Okay. So this one you can decide not to do any computation. You can just use English to tell them how this particular instrument should be accounted for with the figures. Okay. So this instrument should be classified as financial asset through profit or loss. If it is true profit or loss, that will be under current assets because we can sell within a year. It can be converted into cash within a year. So that will be under current assets. So the instrument will initially be recognized at 45 million. So initially, question 2. Okay, so this instrument should be, so question 2, and That will be Doma. This one, these questions are for these people. These questions are for financial reporting people because this is small boys here question. Okay. So corporate reporting people, don't be wasting your time or don't be doing much, although they can combine it with something, but don't say that, oh, you are getting this one, so you are okay. No, this is not your question. Okay. So that will be Doma. Then the instrument should be recognized. So initially recognized at its cost at 45 million. 45 million. Okay. And what is the what? What is the coupon interest? What is the actual interest on this?
5.
Okay. So the coupon interest of 5 million should be taken to profit or loss. This one, you can't use the effective interest rate and you can't use the yield to maturity because this particular instrument will not be what? You are not going to be holding it up to maturity and you are not even going to be what? You are not even going to be receiving any premium on it. So the interest rate will still be the coupon interest rate. So that yield to maturity, please forget about it. All right. So what will happen is that the 5 million should be taken to profit or loss as a finance income. So 5 million taken to 5 million to profit or loss account as financed income. Okay. So what is happening? At the end of the year, we fair value because this is true profit or loss. At the end of the year, we fair value. What are they saying? At the reporting date. The value has reduced to what?
43, 43.
So what will happen now? What was the initial value? 45, isn't it? Okay. Now,
Yes.
now it is what? 43. So there will be a fair value what?
Loss.
Okay. And that will be taken to
Loss.
the fair value loss of, would that be 2 million?
Yeah.
Okay. That will be taken to what?
P&L.
Okay. P&L. Okay. And at the end of the year, the instrument will now be what? The value of the instrument will now be 43 million financial assets. So the value will now be 43 million, which is the new value. Okay. Financial assets under current assets. Under current assets. Because this is going to be, it can be sold within the short period. So current assets. All right. So that is all about that. Question number, okay, question number 3. I want us to solve on all of them, all the classifications. So we have done the amortized cost, we have done the profit or loss. Let's do
Question number 3.
a question on other comprehensive income.
On 1st November 2020, Somanya purchased 80 million shares, representing 9.9%.
Roxanne, we can't hear you. Auntie BC, are you there?
On 1st November 2020, Somanya purchased 80,000 shares, representing 9.9% of the total issued share capital in Krobo for 500,000 plus transaction cost of 4,000. Somanya directors see that the Krobo investment as a strategic one and have no intention of selling shares. Consequently, they have designed the this investment to be measured at fair value through other comprehensive income. On 30th June 2021, the reporting date, Robo shares were trading at a price of 6 pesos each. No entries have been made except for the purchases being included in non-current assets and the transaction cost written off as part of operating expenses. Required: explain the correct accounting treatment of this investment and show how it should be dealt with in the 2021 financial statement of Somaya.
All right. So you can see that this one, the question was so, or the examiner was so generous to tell you that this is how they are going to classify it. Okay. From here, they can decide not to say anything again. Let's see. So this one, from here up to this place. So they can decide to ignore this. They can decide to ignore this side of it, because from here you should be able to, from this side, you should be able to know how the financial asset will be classified. This is through what? Equity instrument. So the classification is only to profit or loss or other comprehensive income. So since they have no intentions of selling the investment, then that will be through other comprehensive income. So they don't have to tell you again, but they have given you the classification. Okay. So if we are classifying the financial asset through other comprehensive income, what happens to the transaction cost?
Capitalize it.
Okay. So what will happen is that we have to go and take it. They have written that off as what? As operating expenses. That is wrong. So this transaction will be classified as what? As a financial asset at a fair value of 50,000 plus the transaction cost of 4,000. So the transaction cost should be capitalized instead of what? Instead of expensing it. So we have to go and reverse our what? Our transaction cost as an expense in the profit or loss. So at the end of the year, they will give you a dividend. This is shares, so they will pay a dividend. But the question has not given us a dividend. Please, the 9.9 over here is not the no for equity shares. We don't have interest rates. They only declare the dividend based on the profit made, and you just take your portion of it. So don't say the 99.9 over here. You are coming to apply it on what? 504,000 to get dividend. No, this is not a debt instrument that you'll be carrying what? A fixed interest rate. No. The shares that you are buying, this is just your holding. So in terms of percentage, this is your holding. So if they declare dividends, you find this portion of the dividends. Your portion of the dividend will be 9.9%. And the question is not giving us any dividends, but you just say that if any dividend payment should be taken to profit or loss as a finance income. Okay, but there is no dividend here. So you just focus on the issues given to us. Okay, the financial asset should be initially recognized at the fair value of the 500,000 plus the transaction cost of what? The 4,000. That will give us 504,000. Okay. Any dividends received or any dividend paid to the Somaya should be taken to profit or loss as an income. Okay. At the end of the year, what do we do? At the end of the year, what will happen now?
We fair value.
Okay, we fair value. Okay. So let's look at the question number 3. So let's look at the initial recognition. The initial recognition will be the purchase price. The purchase price of 500,000. Then we have the transaction cost of 4,000. That will give us, there's no discount. So we have 504,000. Okay. So let's come to our subsequent measurements. Subsequent measurement will be fair value. So we fair value this at the end of the year. Okay. So we have our balance at start. balance at start will give us 504,000. Let's come to the closing balance now. Okay, you just find the closing balance. I know. So the closing balance will be what? How do we find the closing balance? How do you find the closing balance?
The shares purchased and the value of the shares after that date.
Okay, so on 30th June, the reporting date, the share we are trading at what? A price of 6.548. So the current share price at the reporting date is 6.54. But how many shares are we buying? Or how many shares we are purchased?
80,000.
80,000. So our value will be 80,000 multiplied by 6.4. What are we having?
523,200.
523,200. What is happening there?
Fair value gain.
Fair value gain of how much?
19,200.
19,200. So this fair value gain will go to other comprehensive income. All right. So what you do is that you can show your extracts. Okay. So extracts now, profit or loss extracts. So the profit or loss extracts, what we have is that we have the transaction cost should be reversed of 4,000. It was charged as an expense first. Okay, so you come to other comprehensive income. Other comprehensive income, you now have the fair value gain. The fair value gain of 19,200. Statement of financial position extract. You have your financial, you have your non-current assets. Then you have the financial assets to be 523,200. That will be the new value, which is the fair value. All right. So let me see whether there is another question there. For the equity, one there is nothing over there for the equity one. Let me look at this one. So let's just take the question 5. Then we make that.
Please, can you get to the worksheet for me? No, the last portion. Okay, sir.
All right. So let's look at the question 4 is disposal. So that disposal, I have this thing for the disposal here. I have this thing for the disposal here already. So we look at that under the disposal, factoring, and also some other issues. So I'll add a factoring to this one so that we'll be left with disposal and impairment. Okay, because I'm almost done with this one. So let's look at the question number 4, which is the charitable loan. Question number 4, rather. No, this is under, sorry, this is under impairment of financial assets. Sorry. Question number 5.
Question 5. Santase has made a loan of 50 million to a charitable organization for the building of new sporting facilities. The loan was made on 1st June 20x2 and is repayable in maturity in 3 years' time. The interest rate on the loan is 3%, but Santase assesses that an unsubsidized rate for such a loan would have been 6%. The first interest payment was made on 31 May 2x3. Santase initially recorded the financial asset at 50 million and reduced this by the interest received during the period. Loss allowance has been correctly dealt with. This can you scroll down? So required. Discuss with suitable workings how the loan to the charitable organization should be dealt with in the financial statement of Santase for the year and
All right.
the 31 May 2x.
Okay. So for loan given to charitable organizations should always be valued or should always be measured initially at what? Fair value. The fair value is the present value of all the cash flows under the what? Under the arrangements. So they are giving the loan to the people at the interest rate of what? 3%. Okay. The loan will be for how many years? What is the
3
duration?
years.
That will be 3 years, isn't it? Okay. So they will receive an interest of 3%. They will receive an interest of 3% forward for 3 years. That is the first cash flow. At the end of what? The third year, what will happen? They will pay the money back, isn't it?
Yes.
They will pay the 50 million back. Okay, so the cash flows over there are going to be the yearly interest and also the what? The principal payment at the end of the third year. So a loan to a charitable organization should always be measured at the fair value. And the fair value means what? The present value of all the cash flows or their market value. All right. So how do we calculate that? How do we determine the market value? How do we determine the market value? So we have question 5 there. Then we look at the initial recognition. And the initial recognition should always be at the fair value or the market value. And how do we do that? It is the present value of all the cash flows. So we have our years, then we have our years, we have our cash flow, we have our discount factor. The discount factor will always be the interest rate of what? Of a loan that is not going to be given to a charity. If the charity should undertake this particular transaction with what? A commercial institution, what will be the interest rate? That will be the 6%. So the 6% now is the effective interest rate. So we now calculate this one. Then we put a present value here. So we have the years, the interest will be year 1 to year 3. That will be constant. So if it is constant, if the amount is constant for every year, we use annuity. So if it is constant, we use annuity. What will be the interest payment for every year? That will be 0.03 multiplied by 50. What are we having? What are you going to have?
1.5 million.
1.5 million. Okay. So we are going to be having 1.5 million for this. Okay. At the end of the third year, what will happen? They will pay the 50 million, isn't it? All right. So what will happen now is that we will, so let's find the annuity. 1 minus into bracket 1.03 exponent -3 divided by 0.03. Then we find the discount factor 1 over 1.03 exponent 3. What are you having?
First one is 2.673.
2.673. Okay, the second one
The
is what?
second one is 0.915.
0.915. Okay, if we multiply, what are we getting?
The first one is 4.01.
4.01.
Second one is 45.75.
45.75. The total is what?
49.76.
49.76. So this is how, but what is the total amount given to these people? Yes, please.
The annuity factor is 2.829.
Okay, I'm coming. Let me confirm it.
Yeah, that's it.
Okay, 2.829. Okay. No, it's not. It's not. It's supposed not to be 0.3. It's supposed to be 0.6. Sorry. Okay, the discount factor is 6%. Sorry. So it's supposed to be 1 minus into bracket 1.06 exponent negative 3 divided by 0.06. So 1 over 1.06 exponent 3. All right.
The one I mentioned to use for 6%. So that's the 2.673. That's for 6%.
2.673. Okay. The third year will be 0.840. So 0.840. Is that confirmed? $0.840.
Yes, 840.
Okay, so let's now multiply. This will be 4.01. Okay, and this will give us what?
The third year, which this percentage are you using?
Yeah, please, you said?
I said the third year, which percentage are you using? Are you using the 0.6 or the 0.3?
The discount factor is 6%. I'm getting 42 million for this one. Yeah, I'm getting 46.01. Okay, so the fair value of the loan is 46.01. But how much is the company giving to the charitable organization?
Three
15
percent.
million.
They are giving how much?
The loan given is 15 million.
Okay, but what is the value of the loan?
3%.
No, what is the value of the loan? What is the fair value of the loan? What is the market value of the loan?
46.01.
Okay, so
The market value is 46.01.
okay. So what will happen is that the financial assets will now be recognized at 46 million. Let's just say 46 million. Okay, then you now recognize the difference. Okay, the difference will see like you are giving a grant to these people, or you just recognize it as a loss. Okay, because you are giving to them more than. So we have profit or loss, which will be an expense. Profit or loss of 4 million. So the financial asset will now be at the fair value like this, 46 million. But if it should be a convertible instrument, you'll be saying that it's equity. No, it has nothing to do with equity here. The loan will be for charitable organization. The loan should always be measured at the fair value. What do you mean by the fair value? It is the present value of all the cash flows. So any difference between the amount given to them and the present value of all the cash flows will be recognized to profit or loss as an expense. So we are going to be recognizing 4 million to profit or loss as an expense. Okay. So this particular loan subsequently will be measured like this at amortized cost. Okay. So we have the subsequent measurements. To be amortized cost. So we have the balance at start. Okay, so the balance at start will be the 46 million. Then you have your finance income. The finance income will be the effective interest rate 0.06 multiplied by 46. What are we having? Then you have your coupon. Your coupon will always be 0.03 multiplied by 50 million. That will give us 1.5. So what are we having for the finance income? I'm having 2.76.
Sure.
Okay. What will be the total figure?
$47.26.
Okay. So this will now be the balance to statement of financial position. But if we come to statement of profit or loss extracts, okay. So you have your fair value. Okay, you can call it fair value loss to the loan debt, which will be 4 million. You have a finance income of 2.76. Then your statement of financial position extracts. You have your non-current assets. Then you have the financial assets or a loan or charitable loan, anyhow you call it. And that will be measured at 47, which is a closing balance there. Okay, so for the financial assets we are done. Let me look at the receivables, the factoring. Let me just, because we still have some time there. So let me just talk about the factoring. Then we know that we are down with the factoring and the financial assets. Then we just focus on the impairments and the disposal and the loan modification. Okay. So the factoring has to do with receivables. Factoring has to do with what? Receivables. Where you have receivables and you need money. So what you do is that you decide to go and sell the receivables to a debt collection company, which you call the FATA. Okay. So you can decide to go and sell your receivables to a factoring company, which is called the FATA. So you have some receivables over here. The people, they are very stubborn. They don't want to pay. They don't want to settle their debts. So what you do is that you need money and you can go and outsource the collection of the receivables, or you can sell it to them. So for the factoring, for you to know how you are going to account for it, you have to know whether it is without a recourse and also with a recourse. So if you say factoring without a recourse means that factoring without a recourse. Okay. Factoring without a recourse means that if your receivables is okay, if your receivables is 10 million, okay, and you went to what? Collect what? 8 million from what? From the factoring agency, and you are telling them that, okay, this 10 million, just give us 8 million. We don't care. We don't care whether you are able to receive the remaining amount. We not come for what? Any reimbursement again. So it means that just go and chase the people for the money. Whether you collect the money or not, it's none of our business. You are giving us the 8 million, and that is the final settlement. We won't come for any additional reimbursement if you are able to collect all the 10 million. So in this case, it means that all the risks associated with the receivables has been passed on to what? To the factoring company. All the risks associated with what? With the receivables has been passed on to the factory company. The question will tell you that the company is receiving the 8 million as first and final settlement. There will not be any additional advance from the factory company. If that is the case, that is the factoring without what? Recourse. Factoring without what? A recourse. So what will happen is that if you want to know how to account for this, you have to know the level of risk that has been transferred. Who is going to be bearing the risks associated with the receivables? Is it the company or is the factory company? The debt of or the risks of bad debt and those ones, who is going to bear it? It will be the factoring company. Because if the people are not able to pay them, it is none of our business. And the factor, is he a financial institution? We can be doing this arrangement as what? As using the receivables as a collateral security to take the loan. So you have to ask yourself, what is the level of the risk? Who is going to be bearing the risks associated with the what? With the receivables? Is it the company or the factoring company? The factory company, is he a financial institution or a normal individual? So you have to look for those things, and the question will give you a clue on those things. So factory without a recourse is a situation where the company will give the receivables or will sell the receivables to the factory company for just an amount, and that is the final settlement. There will not be any additional money coming from the factory company, even if they are able to collect all the debts. So what will happen is that we are now selling 10 million for 8 million. What will happen? Are we going to still be having receivables in our books?
No.
Okay. So what will happen is that if it is factoring without a recourse, what the company will do is that we are now selling the receivables. It means that the receivables, only 8 million were able to pay their money. So what we'll do is that we did recognize the receivables under the recourse. We did recognize the receivables, which will be the 10 million. Then we recognize cash of 8 million. Okay, what will be the difference?
2 million.
Okay, so you have 10 million, but only 8 million. Okay, you have 10 million, but you are able to receive only 8 million. What will happen to the 2 million?
A loss.
Okay, the 2 million will be classified as a bad debt. All right. So the 2 million will be as a bad debt. So you remove the receivables because you have collected the money. You have sold the thing to the people. So you're not going to collect any money from them again. So it means that you assume that you are able to collect only what? 8 million of the receivables. The remaining 2 million is a bad debt. Those people, they will not pay again. That is a factoring without a recourse. But you also have factory with a recourse. Factory with a recourse, what will happen is that the factory company is going to make an advance to the company. And they will tell the company that if we are not able to receive this money within 6 months or within this month, we are bringing back the receivables to you and you pay interest on the amount that we have given to you. They are telling you that we are going to chase the people for 6 months or 3 months or 4 months. The question will tell you, okay, if we are not able to receive the money, we will now bring the money back to you. We now bring the receivables back to you and collect our money with interest. Okay, or they also tell you that if they are able to collect the money, they can also make additional payment to you. But if they are not able to collect it, they will bring the money back to you. They will bring the money back to you, or they'll bring the receivables back to you, take their money together with interest. In this particular arrangement, who is going to be what? Bearing the risks with the receivables? Who is going to be having the risks associated with the receivables? Is it going to be the factory company or the company itself?
The company itself.
Okay, so if that is the case, the receivables will still be shown in the books because the receivables will be brought back to us. So we can't really recognize the receivables. So receivables will still be in the books, but the amount that we are receiving from the factory company will now be recognized as a loan. So if this is the arrangement, that will be a factory with recourse. They will bring the money back to you if they are not able to collect the money. They will bring the receivables back to you, take their money together with interest. So you classify the amount taken for the factory company as what? As a loan. And the question will give you interest rates. So if you have taken a loan maybe from June to December or from July to December, that means you have done 6 months. You can calculate 6 months interest on the loan and take it towards profit or loss. Okay, so that is the factoring without a recourse and factoring with a recourse. The question will give you a clue to know whether it is a recourse or it's without what? A recourse. Let's look at a question there, then we end it on the factoring of receivables. It's not any big deal. All right. Okay, let's see whether we can tackle all the 2 questions there. Okay, the first one.
Question 1. Joabin held a portfolio of trade receivables with a carrying amount of 4 million at 30th April 20x4. At that date, the entity entered into a factoring agreement with a bank whereby it transferred the receivables in exchange for 3.6 million in cash. Joabin has agreed to reimburse the factor for any shortfall between the amount collected and the 3.6 million. Once the receivables have been collected, any amount above 3.6 million, less interest on this amount, will be repaid to Joabin. Joabin has recognized the receivables and charged 0.4 million as a loss to profit or loss. Can you scroll down? Required. Outline the rules in IFRS 9 financial instrument relating to the recognition of financial assets and discuss how these rules affect the treatment of the portfolio of trade receivables in Joabin's financial statement.
Okay. So what are the rules? Did that mention rules to you? Did that mention something that you have to use to determine whether you are going to be derecognizing or you are going to be classifying the instrument as a loan?
Yes, please.
Okay, what and what?
And please, if you like,
Okay, what was the first thing that I said? Who bears the what?
the risk.
Okay, so in this case, who bear the risks associated with the receivables?
Joabin.
Okay. Does the factor has a recourse?
Yes.
Okay. Does the factor has a recourse?
Yes, please.
The recourse is how much?
3.6.
Would the recourse, the amount for the recourse,
0.4.
no. The FATA has a recourse of 3.6. Okay, the 3.6 forms the majority of what? Of the receivables, which is the what? Which is the 4 million. But the first rule is the risk. Who bear the risks associated with what? With the slow payments. Job. Okay, and you can see that the FATA has what? A recourse. And the recourse amount is what? It's more than the majority of that particular receivables. So the standard says that we should determine who bears the risk of what? Of the slow payments. And that will clearly be what? Job. And determine whether the FATA has a recourse or the FATA does not have a recourse. So the recourse means that will the FATA come back for his money, or the money given to the bank will not be collected back. So the FATA has a recourse here, and this recourse will be together with the amount plus interest. And the recourse amount is even more than what? More than the majority of what? Of the receivables. So it is clearly seen that Draben bears the majority of the risks with the slow payments, and therefore the amount received from the FATA should be treated as what?
A loan.
Should the receivables be derecognized?
No.
No.
Okay. So what will happen is that the transaction must be reversed. Draben must what? Reverse this transaction. So what you do is that reversing this means that you have to bring your receivables back. So you bring your receivables back because the receivables has been what? Has been, okay. So what you also do now is that cash has already been debited, so we don't have to bring the cash in here. But what will happen now is that we now credit a loan of 3.6 million. Okay, the bad debt should also be reversed. We now credit profit or loss of the 4.5 million. So the amount, the receivable should not be what? Should not be derecognized. The receivable should still be in the books. No bad debt should be what? Should be recognized. But they have to treat the 3.6 now as a loan. So you just ask yourself, who bears the what? The majority of the risks associated with the low payment. Then does the FATA have a recourse? The recourse means that would the FATA demand for what? The advance payments with interest. If the people are not paying, does the FATA have the right to what? To ask Joben to what? To pay the amount given to him, or to what? To bring the what? The receivables back to Joben and collect their money together with interest. And that is the case over here. So this is a factoring with a recourse. Joben cannot derecognize the what? The receivables. Let's take the last one. Then we end it.
Sir, please, a question.
Yes, please.
I thought from the question, you said Dragon has derecognized the receivables and charged 0.4 million as a loss to POL. So since they've derecognized the receivables and we are reversing the transaction, I was thinking that maybe the receivable figure of 4 million, you are supposed to debit the receivable with 8 million so that the initial one that he credited, if you should debit it with 8 million, then it will come back to the normal 4 million. Or
Are you saying that there is no receivables in the receivables account before it was derecognized?
I'm saying that the receivable was there, but they recognized the 4 million.
So receivables account will now be what?
I thought we would debit it with 8 million.
Forget about it. Forget about 8 million. There was a receivables of 4 million on the account, isn't it?
Okay.
And this has been derecognized. So what will be the balance now on the receivables account?
Zero.
Okay, zero.
Okay. So if it is zero now, if you are going to put 8 million there, what does it mean?
It's going to have a debit of 4 million.
No, it's going to have
No,
a
it will
debit of
get
8
8
million.
million.
This is not an error. It doesn't mean that receivables should be debited and they went to credit it. So if they went to credit it, it means that instead of the receivables having a debit balance of 4 million, they are now having a credit balance of 4 million. So for us to be able to make the debit side be 4 million, we have to double the amount. This is not an error. The receivables was there 4 million. They now remove it from there. It means that receivables account now is 0. So if you have to go and put the 4 million there. There was a balance, there was a debit balance before they remove it. So they will now be 0 and you have only 4 million.
Okay, yeah.
Thank you very much.
All right. So last one. Okay.
Question 2.
All right.
On 27th September 20X9.
Stephanie will read.
Oh, okay.
Oh, Roxanne.
Please read.
On 27 September 20X9, Tamale Co. Finance Director asked the accountant to record a cash advance of 3 million received from a customer. WACO as a reduction in trade receivable. Sorry, WACO. Okay, sorry. Let me start again. On 27th September 20X9, Tamale Co. Finance Director asked the accountant to record a cash advance of 3 million received from a customer, WACO, as a reduction in trade receivables. WACO is solely owned by Tamale Co. Finance Director. The accountant has seen an agreement signed by both companies stating that the 3 million will be repaid to WACO in 4 months' time. The finance director argues that the proposed accounting treatment is acceptable because the payment has been made in advance in case WACO wishes to order goods in the next 4 months. However, the accountant has seen no evidence of any. Please, can you scroll down? Okay. However, the accountant has seen no evidence of any intent from WACO to place orders with Tamale Co. Required discuss appropriate accounting treatment which Tamale should adopt for all issues identified above.
All right. So this is the question, and you see the finance director should ask what? Cash advance. The question is the customer. Is the customer a factoring company? The customer over here, do we have any information to know whether the customer is a factory company and the 3 million given to the company is what? Is for a receivables that a company is selling to them? Can you gather any information like that?
No.
Okay. The customer who is paying, do we have any debt? Is the customer having any debt with us that they are settling?
No, please.
Okay. The only two items that, or the only items that can cause a reduction in existing receivables is where you are selling the receivables to a factoring company without a recourse. So you have to remove or you have to reduce your receivables. Another one can also be provision for what? Allowance. So that will also cause a reduction in our receivables. Then another one is existing customer settling his what? His debts. That will also be a reduction. That are the three major items that can cause a reduction in what? In our receivables. But the 3 million over here does not fall into any of these three categories. So this particular transaction will not come now under financial instrument, but this will now be looked from the perspective of what? Revenue from contract with customers. You can only recognize what? You can only recognize a sale, or you can only recognize a sale when the what? When the goods has been dispatched. Okay, so this one, the 3 million, we are taking it from the people in advance, and this is not a provision. This is not a settlement of existing debts, and this is not an amount that we are receiving from what? from a factory company in terms of what? Factoring without a recourse. So since we are here to deliver the goods to the person, the amounts cannot be what? Recognized, and we cannot even recognize receivables. What will happen is that the 3 million will be recognized as what?
A loan.
The 3 million will be recognized as a loan because we are here to what? We are here to dispatch the goods to the person. And the customer is not part of our existing customer who is settling the what? His debt. If he's part of the existing customers who is owing us and the person is now paying, that will be a reduction in our receivables. He's not even a factory company. That is what? That is buying part of our receivables. And the 3 million is not even a provision. Those are the three items that can cause a reduction in what? In the receivables. And the 3 million does not fall into any of this category. This is in respect of what? A future order, which we are here to deliver. So the 3 million should be treated as what? As a loan. In the case of what? IFRS 15, revenue from contract. Whenever there is an advance payment and the goods are here to be discharged, the amount that you are receiving will be treated as what? As a loan. If it is with a construction asset, then you have to calculate a borrowing cost on that loan and add it to the what? The construction assets. All right. So the finance director, although he might be a professional, but he's wrong. He doesn't understand the principles of the standard. So the 3 million cannot be recognized as what? As a reduction in receivables. So you can state that the only three things that can cause a reduction in receivables is where we are selling a part of the receivables to a factory company without a recourse. But in this case, the customer is not what? A factoring company. The customer is not a factor. And the other item will be what? A customer settling his existing what? Debt. The advance payment is not for all the customer is not what? Part of our existing customer. He's not owing us. And the other one is the what? Provision for what? Doubtful debt. Provision for allowance of receivables. The 3 million is not a provision. So that cannot be treated as what? As a reduction in the receivables. However, the 3 million is respect of goods that are here to be dispatched. So in that case, the IFRS 15 is saying that payment in advance towards what? Stock or inventory, which are here to be dispatched, should be treated as what? As a loan. So if you have any interest, you charge the interest on the loan to the profit or loss. That is it. So they cannot classify this as what? As a reduction, or this cannot be taken to receivables as a reduction. That is all for this one also. Please, any question?
Please, can you go over the explanations again?
Please, I didn't get you.
He said you should explain it again.
I should do what again?
Explain.
So the finance director is what? Is proposing that the advance payment should be what? Should be treated as a reduction in what? In receivables. So you have to let the finance director knows that the only three items or the major three items that can cause a reduction in the receivable is a situation where one of them is that we are selling part of our receivables to a factory company without a recourse. So in that case, we are selling the receivables. So the money that we are receiving will be reducing our receivables and we'll be recognizing the corresponding bad debts. But the 3 million is not from all that. The customer is not what? Is not a factor. And the 3 million is not in respect of what? Factoring our receivables. So that cannot be taken there. Another one is, the second one is what? Existing customer settling his what? His debts. Someone who is owing you and the person has paid parts. The person's debt will be what? Will be reducing. So the 3 million can be treated as a reduction in what? In the receivables. But the customer is not making or is not settling his what? Existing debt that he has with the company. It's an advance payment. So that cannot be taken to what? To the receivables as a reduction. The next one is the provision for receivables, which will be provision for doubtful debts. We are thinking that part of the receivables will not be received. So that can also be treated as a reduction. But the 3 million is not a provision. It's not a provision. So that can also not be seen there. But the 3 million is in respect of goods that are yet to be dispatched to what? To the customer. So since we are here to dispatch the goods to the customer, the 3 million should be seen as a loan and until the goods has been dispatched. That is the time that we can recognize the 3 million as a revenue. So we recognize the 3 million as a deferred revenue or as a loan for the 4 months. It's relating to what? Sales that we are going to be making, but we are here to make the sales. So that should be treated as a deferred revenue or a loan for what? 4 months. All right, so that should not be taken as a reduction to what? To the receivables. I hope you are okay now.
Yeah,
So,
Linus,
Yes, please.
I also realized that WACO, the company WACO, is solely owned by the finance director of WACO.
Okay.
So in that case, will it be appropriate if you say something
That will be about ethical issues. So if they ask you about ethical issues,
in our answer to this question? That time is doing insider or anything? I don't know.
that will be an ethical issue. So if they ask you about ethical issues, then you bring in those ones.
Oh, okay.
Okay. All right.
Okay.
Okay. So that will be an
Okay.
ethical issue. That will be an ethical issue. All right. So if we don't have any further questions, we are ending it over here,
yeah, you know how to.
and we are looking at impairment of financial asset tomorrow. Yeah, Auntie Emilia.
Yes, good morning.